If you're like most options traders, you're sick and tired of scratching your head trying to figure out the options chain and master the Greeks. In this video, I'm going to demystify everything you need to know about the options chain and how to leverage the power of the options Greeks so that you can put yourself ahead of the curve and take profitable options trades. My name is Sean Kozak, founder of NSTA, and for the world's best trading education and strategies, make sure you hit that subscribe button. Don't forget to turn the notification bell on so that every time we put out content like this, you can get results. Last but not least, give me a double thumbs up so we know you like the content and you're engaged with us. Now, moving forward, there's some content that we put out that is, great, and then there's some content that kicks ass. This is a video that is going to rock your socks because one of the things that I learned early on as an options trader is how to use a simple hack in the options chain that is going to simplify your world moving forward. Now, I'm going to give you a little bit of background so you understand the story. When I first got started, I was taught how to trade options by a market maker on the exchange. And he taught me a secret that I've never really explained until now, and I'm going to share it with you. And what we're going to do is we're going to talk about that moving forward, okay? So, when it comes to trading options, you need to know that there's a lot of moving parts in the chain, right? And the options chain is an overwhelming place for new traders, and we're going to fix that for you moving forward. The key thing here about the Greeks is that there's a delta, there's a vega, there's a gamma, there's a theta, and a rho. And all of them play a factor in options valuations, and all of them play a factor in how profitable your trades are depending on how well you're trading the options market. And what we're going to do is we're going to teach you how to build a position review. We're going to give you a checklist moving forward so that you always know what you're doing. You always have a roadmap to how to build a proper trade. But what I really want to share with you today is my most favorite secret that I've ever shared in the options trading space. And the only people that know this are the traders in our trading room. Until now, I'm going to share it with you. I have a golden hack around the delta that is going to make your delta, your vega, your gamma, your theta, and your rho all simple so that you never have to stress out about the options chain. And it's a secret hack. I was taught this by a market maker, and I'm going to share it with you. So be sure to check this video because it's super critical. What we're going to do is we're going to jump on the charts. I don't want to waste any more time. This is a video you don't want to miss. All right, traders, welcome back. We're going to get started here with Options Explained Part 5. And this is an interesting topic because it's all about the Greeks. And I know that kind of sounds interesting, but we're gonna get into it, and we're gonna break this down so you have a good understanding of what it is and how this translates into option contract valuation. So first and foremost, let's talk about the Greeks. And I don't mean we're not going to the Colosseum and fighting with the gladiators here, right? What I do mean, though, is that it is kind of an important discussion with options. So what are Greeks and why do we use them? Well, Greeks are used as a tool when trading options to analyze and measure the risk of the option contract. So their calculations are used to measure elements affecting how options are actually priced. And we use them to qualify and quantify the risk so that we pick the right option contract based off what we're looking to. And what we do is we use them in accordance to the option chain when we select the appropriate option to trade. So it's really important to kind of understand them, but there are some rules that we've kind of built, and I've got a checklist and I've got a summary sheet that'll help you understand the do's and the don'ts so that you don't have to try to figure this out all the time on your own, okay? One thing you can really appreciate here with us is that we've really tried to do the heavy lifting for you. We'll tell you what's really important, what's not, what you need to focus on, what you don't, and then ultimately, kind of weed out all the extra stuff that's not really relevant, right? So there's 5 main Greeks, okay? And it's technically what we call options language, so to speak. So all we're doing is Greeks are part of the option trading industry. It's something that option traders will learn. And the first one is delta. The second one is vega. The third one is gamma. The fourth one is theta. And the fifth one is rho. And simply put, it's just they're just 5 different elements of the option chain that you're going to be able to see. And so what I'll do is I'll show you what this looks like in the option chain. So let's pull up an options chain here. Maximize this so you can see it. And right now we can only see one Greek in the option chain. So there's only one Greek that's actually here, delta. Okay, so I'm gonna add I'm going to add the other filters in here. So we're going to go into your customize columns. And let's go together and let's add some Greeks to the option column. Now this can be done on any platform. So if I go here to say TC2000, I've already added all the Greeks. You can see I've got delta, gamma, rho, theta, vega. Okay, so I've added all the Greeks in the option panel. If you go to Thinkorswim, I've done this as well. So if we go over here to the charts and we go over to analyze and I look inside the options chain, I've only got the delta in this one here because it's the most important one in our experience, but you can add all of the others in here as well. So one thing you can do is you can go up here and you can go to customize and you can go down and you can add all of the deltas and the gammas and the rhos and the thetas and the vegas here. So since I'm using, there's several platforms for this example. I'll show you Questrade as well. Questrade is, we've got several of the options. Right here, we got rho, vega, theta, gamma, delta. So all the Greeks are right here, and you can see them. And it's just really a part of the option chain. Really, that's what we're referring to. So let's go in now and take a look at. I'm going to add them in here to the TradeStation one together, so you can see exactly how you would do this. So let's go down and find the next. We got gamma. Let's add gamma. So I'm gonna take the gonna move these. I'm going to move these together so you can see delta, gamma. Let's go here and find the next one. So we got delta, vega. We got to go down and find vega. Let's go find vega. So I'm going to keep them. I'm going to move the vega up. So we'll do delta, vega. And we'll do gamma. And the next one is theta. So we'll do this together here. So theta is there. Okay. And then we're going to go and we're going to add rho. So rho is here. Okay. And so delta, vega, gamma, theta, rho, right? Sounds like we're in a sorority house here, and it's a play on words, right? A couple of the things I want to put in the options chain here, just so you understand some of the things that you want. The volume, I like to have the volume in the options chain. We could add the symbol. We could definitely add the symbol. So let's bring the symbol up. And I think it's just good to set up your option chain the way you like to see it. So let's move the symbol up. So let's move the volume up. Open interest, implied volatility. Remember we talked about volatility in the prior lesson. So let's go up here and let's go. So we got ask size, bid size. We've already got the ask. We've already got the bid. Okay, we've already got that there. That's the ask size and the ask bid. I'm not really interested in the ask size or the bid size. I just want the bid and the ask prices. There's the close. There's the expiration. Okay, we're going to add the expiration date here. And then we've got intrinsic value. I'm not really interested in adding the intrinsic value and stuff like that. I'm not really adding the probabilities of things adding. You could add them in there, and these are just some more advanced stuff. But I'm going to leave that expiration date there, and we're going to add that. So there's a more a customized options chain, bid ask symbol. So we've got the. Let's take a look here. Okay. So let's take a look here. Symbol, position, okay. So that's the position column. So what we're going to do here is I'm just going to make sure I've got my option change set up so you can see it. So we've got rho, theta, gamma, vega, delta, implied volatility, interest, volume, symbol, bid. So you can see what they do is they put the symbol. I like to have the symbol here because you can actually type that into the actual chart and you can see the option itself. And so that's kind of like the option ticker, so to speak. So let's work our way from the strike price so that you understand this. We've got the strike price here, expiration date, okay, here. And then we've got the bid and the ask, for these are, remember, these are puts and these are calls. We've got the symbol, we've got volume, we've got open interest, that's how many contracts are available to trade. Implied volatility, very important, implied volatility. Now we've got the Greeks, delta, vega, gamma, theta, rho. Perfecto. Okay, so now the option train is there. That's the way we set this up. And one thing you can do is you can save, I believe, customize, and I believe that's just, yeah, it's already set. So that's the way we can do it. And if you wanted to change the look and feel of that, you could. Now that's for all option contracts. So if we wanted to, go in here, you can see that's the way it's set up. You set the option chain up, and I believe, let's double check here, option chain. And so that's really kind of what we're at here. Is we've got the option chain set up. So if I want to go down the option chain here, I can look at, you know, these ones here. Remember the strike prices here. There's a lot of platforms have a lot of filters and customizations. I don't want you to get too caught up on just this example being in TradeStation, but I do think it's important that you understand how to set up your option chain so that you can see what you want to see, especially for the Greeks. You'll see that there's other things you can do with a lot of platforms, like analyzing graphs and manage your positions. So this would be how you track all your orders and the trades that you're in. And if you want to do some specific searching for really advanced option trades, you can. Like I said, this is an intro course. I don't want to take you to become a brain surgeon in this video, but what I do want to do is I want to show you the most important things moving forward. Remember, as with any type of trading, you could take it as far as you want, right? Like even for stock trading, futures trading, forex trading, there's really advanced stuff you can do, and then there's really simple stuff that's really efficient. So we're going to keep it efficient, keep it clean, keep it simple. Okay, so let's get into the Greeks and let's talk about this for a second. Okay, the Greeks, delta. Okay. Delta measures the change in an option's premium based on the change of the underlying price. Okay, so basically, simply put, measures the change in option price when the stock price moves. So it basically has a direct relationship to the option premiums when the stock moves up or down. Okay, delta can be measured in three ways. It can measure a change in premium based on change in the asset. It can be used as a hedge ratio. It tells us how many shares of the underlying we need as a neutral hedge, and as a measure of probability, how likely the option is to expire in the money. Okay, so that's three things that delta can be used for to assist in understanding the option chain. Okay, the big one here is going to be measuring a change in premium based off the change in the underlying. Okay. And we'll get into other option strategies with the Greeks in future videos and in the extended strategies courses, okay? So let's talk a little bit about this example, okay? So let's say we've got the Greeks here. This is delta. Call options. The premium of a call is plus related to the underlying price. So delta for the calls will range between 0 to +1. In the money is +1 delta. At the money is +0.5 delta. Out of the money is 0 delta. So therefore, the closest to 0, the farther out of the money, and the closer to 1, the farthest in the money the option is. Okay? So give you an example. We have a 75 strike call option. So the strike price is 75. But the stock is priced at, if you have a stock price at 100, okay, you're going to see here that that's in the money, right? 75, right? And then the stock's up here at 100. You're in the money. Your intrinsic value is in the money by 25 bucks. Okay, you're probably already over the premium. You're going to have a delta closer to 1 because you're already moving and grooving to the promised lands here, right? The option contract is already further out and it's already making money. Stock prices, okay, if you have 75, if you're here, the strike price is at 75 and the stock price at 75, you're going to have a delta closer to 0.5. And then if, let's say, you're out of the money and your stock price is down here, you're going to have a delta closer to 0, right? So just understand that the delta has a relationship to where your strike price is or your stock price is relative to the strike price. Okay, so very important slide. You want to take a screenshot of this one and a screenshot of that one. Okay, let's talk about puts. Same thing. It's a premium of a put is negative related to the price, right? So got to remember, positive deltas for calls, negative deltas for puts, but it's all just relative to delta. So delta puts, okay, delta for puts range between 0 and -1. And in the money would be -1 because you want the put to drop. You want the price of the stock to drop. So you want a negative relationship to the market, okay? And therefore, and at the money, 0.5 delta would be close to the strike price. The stock is trading close to the strike price. Out of the money is 0. Right? The closer the delta is to -1, the more the option is in the money. The more intrinsic value you'll have. Therefore, delta will be more of a negative number 1. Because essentially for calls, it's +1. Puts, it's -1. Okay, so let's show you an example. Important slide. Take a screenshot of this. Delta put example. Strike price is 70 bucks, $75. Okay. Strike price is 75. If the stock price is 100 bucks, means we're out of the money. We've not made money. It's a put, right? So we're trying to sell this way, right? Strike price is this way. But if we're trading up here, it means the stock has gone up. Still out of the money. And if the stock price gets to here, right, this will have a delta, okay, closer to 0. This will have a delta closer to negative 0.5 or 0.5, okay, 0.5. If we're at 25 bucks, you're going to have a delta of negative 1, right? So this is why it's just close. It's just to understand that relationship. So let's go ahead and take a look at an option chain for a second, okay? I want to use this as an example here. Let's say we got the spiders, right? Spiders here. A second here, guys. Let's take a look at this stock here for a second. Okay. So if we're sitting here, okay, very important. I'll just leave it like that. If we're sitting here at 361.56, current price of the spiders right now is 361.56. I'm just going to show you here, right there. We're sitting here. Okay, that's where the S&P right now is trading. The spiders is trading there. Okay, so if I'm looking at this option contract, or if I'm looking at this stock, okay, the stock price is 361. Simple to put, easy to see. Okay, if I know that, and I go back to the option chain, and I want to go into this option chain for a second. If I look at the November 25 contracts, so if I'm trading here, today is November 16th. So if I'm looking at, November 20th, if I go in here and take a look at this, and we look at delta, we just take a look at these numbers. For calls, you can tell, I can already tell you that a 0.7 delta has intrinsic value. It means we're already in the money. That money is, your option contract is in the money, right? Well, if we go look at, the option, okay, the strike price on that is 357. Well, that makes perfect sense. Makes perfect sense. Think about this. That option contract at 357 is here. So if you're buying a call option, riding the trend up, okay, that 357 strike price, and we're sitting at 361, the intrinsic value is 361.57 from 357. So let's go down and just add that up. I have a calculator here, and we'll just do it together. So if I subtract the current stock price at 361.54 minus 357, I have an intrinsic value of $4.54. Okay, I have an intrinsic value of $4.51. That's why the delta is 0.71, because it's closer to positive 1. And if I look at that same options contract and I take a look at the delta, you can see it's almost at 0, negative 0.29. Because if you were trying to buy puts, you're hoping this market's going down. Well, that would mean the delta is going to be completely against you, right? Like in this environment, the stock's going up, which means you want a delta of closer to negative 1, right? Not negative 0.2. Okay, so that's why if you take a look at, in this environment, you'd be looking at calls because the market's going up, either trading up to the upside. That's why you would want to see the delta here in this relationship. Okay, so it's just delta is a pretty important factor. Just remember that the closer you are in the money with intrinsic value, the higher your delta is going to be for calls. And then the closer your put is in the money, you're going to have the closer to negative 1 is going to be best. Right, so if we look at any market that would be dropping in price, you would see the negative deltas be a bigger number here, closer to negative 1. Right, so remember this. Just keep it in the money options. Plus 1 is the biggest, negative 1 is the biggest, and then after that it drops the further out it goes in the money. Take a look at this. if you think about it, if this is going up, then these put options, the strike price at 364, 364 is right up here, right? So that option contract isn't even hit that yet, right? It's out of the money. Okay, so that is closer to in the money. That's an in the money option at 364. Okay, because you know you'd be buying puts up here, and we haven't even got there yet, right? So that's why that's saying 0.63 is closer to -1, right? It's closer to -1 right here because it still has value, right? And I know it's a little bit different to understand that, but it's just remember this: the deltas are to do with the relationship to whether the stock is in the money or out of the money, based off its value. Okay, so let's go and take another look at a different example. Let's now talk a little bit about, so this is a summary here. I'll just give this. So delta, the closer the delta approaches +1 for calls or -1 for puts, the closer the option mirrors the movement of the stock. If a call option has a delta of +1 for every $2 price increase in the stock, there would be a $2 increase in the option premium. If a put option has a delta of -1 for every $2 price increase in the stock, there would be a $2 increase in the option premium. So just know that the closer you are to +1 or -1, depending if it's a call or a put, the closer you will resemble exact movements on the stock price. Okay, so let's talk a little bit now about the Greeks' Vega. Okay, Vega measures the change in the option price based on a change in the volatility. So remember, we talk about implied volatility versus historical volatility. The Vega has a lot to do with how the option is priced relative to the IV. So the change is usually measured based on a 1% change in implied volatility. Therefore, for every 1% change in implied volatility, we can assume that an approximate $1 change in the option premium will become apparent. So simply put, it measures change in the delta the Vega measures change in the option price when volatility moves. Okay, so let's kind of take a look at this. If I'm looking at Vega, okay, this is the Vega column. So Vega measures a change in the option price, okay, based off of a change in implied volatility. So if implied volatility will change, this will affect the Vega, which will affect the price of the option. Okay, these are the premiums. The premium is what you buy or sell for. So it's going to affect the bid and the ask. Okay, when implied volatility affects the Vega affects the bid and the ask price. Everything is about affecting the premium, the bid and the ask. What are you buying and selling your option contract for? What is your premium, right? And so that's important to know that. Okay, so let's go in here and take a look at the next one. The next one here is theta. Theta measures time decay. Okay, very important to understand this. Time decay is because options are a contract, so there's a lifespan to a contract. So that time decay, it plays a factor on the valuation, right? And obviously, the more time you have in an options contract, the more you have the ability to see that option play out for true fruition, right? So if you have more time, the valuation of your option will be priced according to that time value, and then that's something to understand, is that your valuation is affected by the time. But then when you have to remember that as time changes, right, as time starts to decay and as things start to get closer and closer to expiration, okay, this is going to affect the value of that options contract, because now you have less and less time for that option to work in your favor or work against you. Okay, so theta measures the time decay of the option contract in dollars that day per contract. Okay, so essentially, long calls and puts have a negative theta, which represents they lose value with time decay. Okay, they lose value with time decay. When you're long a market, right, you're a buyer of calls and puts. If you're buying a call or you're buying a put, what that means is you're assuming, always defaults to yellow, never helps a brother out. Okay, if you're long calls, so calls and puts, okay, if you're long a call or you're short or you're long a put, shouldn't use the word short, excuse me. It says the long calls, so theta, which represents they will lose value with time decay. So the reason negative theta apparent is because as time decays, okay, you have less and less time for your option to work. Maybe it's already working, that's fine, but if it's not, if the option hasn't started to move in the money yet, as time decays, okay, the value will decrease with time. Okay, so long calls and puts have a negative theta, which represents they lose value with time decay. Yeah, absolutely. The value of this option loses value because you have less and less time for this trade to play out. Short calls and puts, you're now a seller, okay, has a positive theta, which means they gain value with time decay. Absolutely, right? If you think about this, if you're a buyer of options and you need time to work in your favor, if you're a seller, you're taking the opposing side of a long buyer, right? If you're selling to these people, you're an option writer, you want theta, that theta works in your favor, right? So think about this. Delta is really good for buyers of options. Theta is very good for sellers of options. Okay, and we're going to get into the cheat sheets here. I've got some cheat sheets for you, so it's really important here. So remember, negative is for you want negative is representing the time value, and positive is representing the time value for theta. Let's go in here and take a look at the theta column. Okay, so if you're looking at this option contract, there's theta right here, theta. See, it's all negative theta. Okay. And it's important to understand that because it has to do with time decay. Now, I don't want you to get caught up on all the numbers right now. I don't want you to worry about, okay, well, which one's better, which one's worse. We have a cheat sheet that's going to tell you this, just so that you understand. This is an intro video to get you familiar with what theta is. This is measuring time decay. Okay, so we want low theta as a buyer and high theta as a seller. So let me just put this into perspective here. We want low theta as a buyer. So as you know, that's our primary strategy. We want lower theta. Think about this. If you have a negative number and it's getting bigger, if it's negative 0.3 versus negative 0.9. Negative 0.3 is better for you. It's a smaller negative number. Okay? If you have this as a theta, we want to have a positive theta. We want to have more theta. We want to have a bigger number as a seller. But since most of you are going to be buyers of options contracts, we want low thetas. So if we take a look at this, where's the lowest theta? If you're a buyer of calls and puts, the lowest theta is down here, 0.32. Negative 0.32. Over here as a theta, negative 0.31. That's the lowest theta. Okay. Let's go down here and take a look at some other options chains. Just go to December. The theta is still negative down there. Let's go to June next year. Yeah, it's still really negative. It doesn't really change that much, but the thing here is just understanding what they are and what you're looking for. I like to write little cheat sheets on this, right? So as a, you know, it's really important to know, like certain Greeks are important. Delta and theta are probably the two most important, right? Delta's for buyers. You want delta to understand the buying of the stock or of the option contract. You want theta as a seller. It's definitely important. So we'll give you the cheat sheet, and it'll make so much sense when you're just looking for options because we've got a cheat sheet for you. Okay, so let's go to the next one here. Gamma. Measures the presumed change in delta with a 1-point increase in the underlying. So it demonstrates the speed of change in the delta. It just measures how fast delta is changing as a reaction to the stock, right? Not something I would assume you're probably going to be monitoring too much unless you're basically looking at some advanced option chains and advanced option strategies. Remember what we said here. We're trying to keep it super simple so even a monkey can make money. Not that you're a monkey. I'll consider myself a monkey because I want to keep it simple. I want to make money in the options market, and I don't want to make it hard. Okay, so gamma measures the speed of the change in the delta. So what gamma does is it measures, so if we look at gamma, this column here, it measures the relationship to the speed of change of delta. So it's measuring how fast delta is changing. Okay, I know it gets pretty advanced. Like, holy God, you got to be a brain surgeon to understand this stuff sometimes. I thought that at first. That's why I kept it super simple, and we'll keep it super simple here. Let's talk about rho. Rho measures the change in the option value as a result of interest rate changes. Okay, you're like, how does that affect me? Well, it can affect you, usually measured based on a 1% change in interest rates. Well, if interest rates aren't really changing that much, right? We've got pretty low interest rates right now in the marketplace. They're trying to make it pretty exciting for people to spend money. Out of all the Greeks, this is one of the least relevant, as interest rates don't change that much, right? So, however, it is of little importance to valuing risk in the pricing model. So we're not going to focus too much on it. Okay. So if you're looking at rho, it's not really something that you're looking at too much here. It's not a big deal, so to speak, right? So, a couple things here. You want to know the rules. A couple things I like is, remember I said, please review the Bible of option strategies for detailed breakdowns of how the Greeks are calculated. If you want to go to school on this stuff, and you want to look at the Black-Scholes model, and you want to look at some of the more advanced statistical pricing models that they teach you in corporate finance. Trust me, I spent 3 years in corporate finance, studied statistics, studied options, the valuation of the options models, and I'm here to tell you right now that it's, if you want to enjoy your life and you want to have that freedom of just keeping super simple, great. It's a great way for you to learn, but it's not something that's necessary for active trading. Okay, so I do think you should check out the Bible of Option Strategies for a more breakdown of these Greeks, but I've tried to simplify, my years of studying this so that you don't have to do that. Okay, so in our experience, it has been proven unnecessary in calculating each Greek's value. However, we have determined that by choosing a specific value for delta when you are buying or going long either calls or puts has a benefit. So normally, what I'm trying to do here, and this is something that I learned from my mentor, and my mentor was a market maker on the Chicago Board of Options Exchange. And this is a rule he gave me when I started learning options. I'm going to pass it down to you. When we're a buyer of option calls and puts, we want deltas closest to 0.6. By using this rule has been our experience that all other Greeks align best for trading. Okay, so keep it super simple. If you just look for a delta of 0.6, it helps all of the deltas line up the best. You say, that's kind of like a cheat sheet. You're right, it is. So let me tell you, the person I learned this from is a master wizard of options trading. Like, he was a market maker for the options exchange. He knows a little bit about option trading. Right? I spent years studying with him. And so here's the thing. If that's the case, let's go to the option chains, take a look at it. If I go to delta, if all I know I need to worry about is delta, and I don't need to worry about all these other Greeks, yes? The only two that I would really pay attention to would be delta and theta. Because if I'm going to be a buyer and seller, then I'm going to do that. So let's go back into the customized columns, and now we can keep it super simple. I only want delta, and I only want theta. I'm going to remove the vega. I'm going to remove the gamma. I'm going to remove the rho. Delta, theta. Fantastic. Now I have the two of the most important things I need to look at, deltas and thetas. And take a look at this. Which one do you see here? 0.6. It's around the same delta. And that aligns everything right there. So that would mean the 363 call. Negative 0.6, excuse me. Look at this one here. So if I'm looking at the call option, that would be the put. That would be the put. And then if I'm looking at the call option right here, 0.6, 0.57, 0.57, 0.62, 371. So that's a 360 call price. Yep, 100%. And that's in the money option. And this one here is, let's go back over here to the call price, 362, and I know I'm trading at 361.22. 362.50. If I'm selling a put, right, I need my put to be higher price than my stock price, which puts this one in the money. Makes sense. Super cool. Super easy. So write this down. Write this down. I want a 0.6 delta. Let's pull the slide up here. I want 0.6 delta, -6 delta for puts and for calls. Okay, so here's the thing. Position review, okay? Position review is very important because we're building on the trading plan, right? If you notice now, we're adding, okay, as we build on these lessons, the most important stuff. When you're a long, you're a buyer of either calls or puts. When you're short, you're either a seller of calls or puts, okay? You're bullish, you're either long calls or short puts. You're bearish, you're long puts and short calls, okay? So that's the summary of the position. So when we're a buyer of options, we want low implied volatility. And we're a seller of options, we want high implied volatility. As a seller, your risk is always unlimited, your reward is limited. As a buyer, your risk is limited and your reward is unlimited. And we always want positive deltas. Okay? With long calls, you're gonna have positive deltas. Okay, and short puts, you're going to be positive deltas. Long puts, negative deltas. Short calls, negative deltas. And then remember, theta, we always want high theta when we're a seller of options. And we'll get into that after. Okay, so one thing I want you to practice here right now is I want you to, whatever platform you're using, I want you to go in and set your options chain to have the delta and the theta. This is something that I think is very important that you have moving forward. You want to have your bid and your ask, your strike price and expiration. You want to have the symbol, if you can, the volume of the option contract, open interest, which tells you how many contracts are available for trade. We want implied volatility, and we want theta and delta. So what I want you to do for homework on this is I want you to set your options chain up so that it looks like it has those in it. You can rearrange it however you choose to see it. Okay, you can rearrange it however you choose to see it. Okay, so I'll give you an example. Let's go in here and just take a look at Thinkorswim. Okay, I'm going to go in here to my main one here, my NSTA options. Okay, and I'm going to customize. Right, I'm going to add theta because I haven't added theta here. Okay, and I'm going to save as NSTA options main. I just got to rewrite it. Save as. There it is. Theta. Okay. So now I've got, if we take a look at this environment here, I've got my strike price, my expiration. If I'm looking at calls, I've got my percentage change. You could add percentage change as well in the option contract if you wanted to. You could add the options code, the implied volatility, open interest, volume, delta, theta, bid and the ask. There it is. Same thing. Okay, let's go back to trade station here, and let's go and add percentage change if we can on this. So keep it consistent. Customize. Let's take a second. Do we have percentage change in here? I don't even know if they offer that here. Close, expiration, intrinsic, last, low, mid, net change. There we go. Perfect. So let's add this up. There you go. Net change. Perfect. That's looking like it's clean and organized like the other option chains. So if I'm going into, say, these other option chains, whatever platform you're using, you can see I've got change, net change. I'm going to customize, edit columns. I don't need to see change or percentage change, last change, bid in the ask, bid size, ask size. I don't need that. Volume, open interest, delta, gamma, theta, vega, rho. I don't need the gamma. I don't need the vegas. I don't need the rhos. Okay, set this as a default. Perfect. So now I've got the most important stuff I need. Last change. That's the premium, the bid and the ask. Last price, bid and the ask. Okay. Volatility, volume, open interest, implied volatility, delta, theta. Perfect. Everything's there for me. Now I've got my option chain set up, and we're good to go. Okay, and it's really good to just know how to keep things super simple, right? Keep it organized, keep it clean. Okay, save that workspace. File, save. Okay. And this is done for Thinkorswim. Trade station is done. Let's go into TC 2000, and I'll show you here. We could just go in and we can, in the money, out of the money. You can do that if you choose to. I'm going to edit. I'm going to remove. So delete in the money. We're going to delete the vega. So I don't want to sort like that. Let's delete the vega. Delete the rho. Delete the gamma. So I got expiration, days to expiration, contract size, volume, spread. They've got a few other things on this platform that is really useful. I found that that some of the other platforms don't. So delete Vega, delete theta, rho. We don't need rho. We can delete it. Gamma, we don't need it. Delta strike, perfect. So that's kind of where we're at here on these option chains. We can see that this is useful for us moving forward, and you know, we can bring that over there and sort this out so you can see the entire chain. I think it's really important that you don't feel overwhelmed with your option chain. You should know what you're looking for and how to see through that if we're getting ready for trading. Because as I said before, we're now going to start moving into getting ready for options trading, and we want to go over you know, the finalized stuff on how we bridge the gap here. So great video. Set up your options chain the way I've told you. You've got to have the delta and the theta. We want to have you want to understand that. And if you have any questions on the platforms, we're going to do a video on platforms and making sure you understand the pros and cons of all of them so you pick the right ones. But if you need assistance, right, and you need any assistance with any of this information that we've been talking about here, let us know. And I'll be more than happy to help you moving forward. Our team is just an email and a phone call away. Take care, traders, and we'll see you in the next video. Welcome back, traders. Now that I taught you my golden rule around delta, I know you got a lot of value out of this video. Plus, you're now a master of the options chain and the Greeks, so make sure you hit that subscribe button and don't forget to share this video with a friend so they can get the same results that you are. Now, what we want to do is we want to make sure that if you have any questions or comments, leave them in the chat box below so that we can get social with you, and we'll see you in the next video. Oh, by the way, don't forget to hit those links below. There's a lot of other valuable content in this series you don't want to miss.